All right, well, we got quite a mixed bag on inflation news this week, so we're going to dive in and see how it's affected interest rates. I'll go ahead and dispel any concerns early in this call. Interest rates haven't moved one bit from yesterday, so that's the good news. Today is Thursday, the 14th of August. I hope you are doing well. Well, let's get right into it, y'all. Consumer Price Index came in on Tuesday. Remember, this is a BLS report, Bureau of Labor Statistics. So we're going to see big changes in how that department is run, big changes in how that data is collected. We may see, and this might be the right call, a significant delay in the timing of those reports to allow for real data to come in rather than these extremely flawed speculative models that frankly have become useless over the last couple of years. So glad to see the changes there. It's going to be interesting to see how that affects the numbers that we get on the CPI. But Consumer Price Index came in exactly as expected, y'all. The markets were expecting 0.2% up month over month. That's what we got. We were expecting 2.7% up year over year, and that's exactly what we got. So the market was dead flat with regard to interest rates as a result of Tuesday's inflation data. Then today comes Producer Price Index. This is more heavily weighted towards the wholesale side. If tariff pressures are going to be revealed in a number, it was going to be this number, and that's what we started seeing today for the first time in the data. Market was expecting month over month PPI to be up 0.2%. It was up 0.9%. So y'all, that's a fourfold miss to the upside on PPI. Year over year was likewise up to 3.3 versus 2.4 anticipated. So much harder read than expected on PPI. When I first saw that, frankly, I thought we would see a pretty harsh sell-off in the bond market, but we haven't seen it, y'all. We've seen bonds a little bit weaker today, but not sufficiently for most lenders to show significantly different pricing than they were earlier in the week. I'll dive right into those numbers. Today, Mortgage News Daily has a 30-year fixed conforming loan national average 6.53%, y'all. As we've said many times, this is not a rate quote. This is not where we are in Texas. It's not what I'm quoting. You need to call me for specifics. That is very much borrower in property and loan amount and down payment and credit score driven. This is just the national average of where we are at. We will likely be significantly lower than this for most scenarios. So 6.53 is the national average today, according to Mortgage News Daily. 6.55 is where we were a week ago. So we are still a hair better based on the rally that we saw after Tuesday's CPI report. 30 days ago, we were at 6.83. So we are down a third of a point or so on the month, just under. So that's very good news for the direction of interest rates. I suspect this PPI number today is going to put a halt to that. It's kind of going to put a floor under the improvement that we've seen. We'll see if we get some additional data that will allow us to come down from that. It looks as though, y'all, that the jobs number that we got the first Friday of this month, which was much weaker than expected, is really what's driving predictions around the Fed. So the Fed is more focused, frankly, they're more alarmed by, if we can use that figure, employment numbers than they are inflation at this point, because they know, y'all, whether they will state it publicly, and I know Jerome Powell will not state publicly, but any effect that tariffs are having on temporary prices are just that. They're not driven by inflation. They're driven by a hard cost that's been imposed on imports that is not driven by inflation. It's important what drives inflation, y'all, because the only thing Fed can do anything over is costs that are driven by the ability to increase prices. That is fundamental economic strength that, frankly, their restrictive policies are looking to temper and to slow. They can't have any effect on tariffs with that policy. And so for them to lump tariff accounting in with future Fed policy is just a fool's errand, and it's more about their personal disdain for tariffs than it is over any inflationary pressures they're concerned about. Tariffs are not going to light a fire of inflation. They actually do exactly the opposite. We've gone into that on this video before. Tariffs actually strengthen the dollar. That is the antithesis of what causes an inflation. Inflation is caused by dollar devaluation, specifically printing more than the economy can disseminate. So that's what causes inflation. It's important what the cause is, y'all, and the Fed knows that. Bottom line, Fed is focused now on employment more so than we're seeing in inflation. That's good news for us because we are now seeing a 90.8 percent chance of a quarter point cut going into the September 17th meeting. That's down about 5 percentage points from where it was on our last video, y'all. We now have a 96% chance of a quarter point cut by the 10/29 meeting, and there's now only a 52% chance of us being a full half point lower going into the October 29th meeting. Y'all, that's important because we had seen a much higher likelihood of us being a half point lower between now and October 29th. I do think that we're going to see a quarter point cut at each of those 3 meetings. I think the market is pricing that in, but now a little over 50% chance of that. It was much higher than that, 80s or so, going into this week. So this PPI did hurt us as far as Fed futures are concerned. In any event, I'm going to continue to keep an eye on it for y'all. It's important for the Fed to get in line with, frankly, where U.S. Treasuries are trading. They are suggesting that we are about 1.5 points higher than we should be, y'all. So let's see if the Fed is going to reconsider their stance. The markets are expecting it. The Fed futures are pricing it. So we'll see if they follow through. In any event, I hope this is helpful for you and for your clients. As always, we're honored to have your referrals here. My contact information is on the screen. Stay blessed. Stay safe. We'll talk to you next week.